Hi everyone. Today I'm here to talk about the risk and rewards of lending Bitcoin. There's a way to earn yield on your Bitcoin and you can lend your Bitcoin out to others, but it comes with a lot of risks and it's a really interesting proposition. Recently there's been some controversy with BlockFi and that's what this is going to cover. I'm going to dig in a little bit deeper around that. I'm going to go ahead and switch over to my screen so we can see me walk through what I wrote up on Thursday. So on Thursdays, I write up my newsletter, The Health Report. And if you become a paid subscriber, you get this first on Thursdays, and then I report about it later on YouTube and other channels a few days after. So, all right, diving in here. The background on this is that I've personally been experimenting with lending my Bitcoin to different services over the last year and a half. I do a monthly tweet storm where I give an update on the different services that I've lent to. So I've got 30 Bitcoin that I'm lending out, earning approximately 5%. And I've gone through, I cover different ways to earn yield, and I've got a spreadsheet as well where you can look at I've currently got 25 coins lent out, but you can check out my notes on the places that I've lent to, other places to earn yield, like covered calls. You can also look at disclosures I have and other things as well on this. There's another sheet that covers the different services, the ones that I don't recommend, the ones that I do. I'm not a financial planner, nor am I a CFA or anything. This is not a financial advice. I'm simply giving you my personal opinion as to what I'm doing. And if you find that interesting, that's great. All right. So some basics on the lending market. Lending and borrowing is one of the oldest forms of finance. It's literally probably the oldest. I mean, I'm certain a caveman borrowed something from another person. They had to pay it back at a later date. I'll borrow a fish from you today. I'll give you 2 fish tomorrow. When you lend out Bitcoin, your return is equal. Your return is compensation for the risk that you're taking with your capital. Any lending activity has this inherent risk, and that risk is what is manifested in the form of an interest rate. People lend their Bitcoin in order to stack more Bitcoin because you can get paid back in Bitcoin. Or you can live off of the return. So whatever yield you earn, you can take that, sell it, and use that to pay for your apartment or whatever else you'd like. So Carl Richards has a really good quote about risk, which is that risk is what's left over after you've thought of everything. So taking risk isn't a good or bad thing. It's inherent for any investment. An investor hopes that they've appropriately sized the risk relative to the return. Risk essentially captures the fundamental part of like being a capitalist and entrepreneurial spirit, because you can try to plan for everything, but inherently there's going to be that risk that you can't plan for. And that's what you're being compensated for. Now, when you lend your coins to these services, you have to trust that the service evaluated their counterparty risk properly, including the financials of the borrower, collateral requirements, custody, etc. And that's something that you're just not going to be able to get a good grasp on, but neither do you have that with other type investments. You can't go audit the books of XYZ sort of investment product typically. Some allow you to do that, but some are a little bit more opaque. For example, you can't dig into granular borrower data. You might have aggregate borrower data. All right, so BlockFi. BlockFi is one of the more popular lending borrowing services in crypto. As a consumer, you can lend your Bitcoin to them, and then they lend it out to companies or hedge funds that use it for trading activity, or including BlockFi also has a trade with GBTC. So here's BlockFi's website. For example, they've got a nice calculator where you can definitely tell that they have a lending product because they like people to be able to see how much money you earn. If you lent out, like say you lent out 10 Bitcoins over 6 years, you'd get 2.5 Bitcoins back in yield, which is pretty cool. Now they are doing compounding returns here, but earning a yield on Bitcoin is very compelling. So this is BlockFi. This is their website. They let you lend a Bitcoin, or you can borrow dollars against your Bitcoin using it as collateral. So BlockFi engages in certain trades and also lends to other counterparties to engage in certain trades. And here's a few of them. There's the cash and carry trade where traders buy spot and sell futures and capture that arbitrage. That's covered in this video by Deribit. I work at Kraken. I recommend that everyone go trade at Kraken, but Deribit had a really great YouTube tutorial on cash and carry trade. So that's on YouTube, and you can just Google cash and carry trades. Margin pool. So exchanges can borrow from BlockFi or other lending providers to provide liquidity for their margin pool. An example of that would be Bitfinex. Bitfinex has a lending pool here, and you can look at the interest rates earned annually on different cryptocurrencies or crypto assets. And here's over time historically I believe it's the daily rate for Bitcoin borrowing, and this is in log form. So really interesting, the ability to earn yield that way. It's a great way. It's a a pretty low risk way for the lender to earn yield because the exchange controls everything in their margin pool. They control all that risk. So exchanges like Bitfinex and Kraken both have margin pools. Exchange arbitrage. So traders can utilize crypto to arbitrage pricing deltas between different exchanges. So let's say Kraken has Bitcoin at $60,000 a coin, and Coinbase has it at $59,900. Traders can arbitrage that difference, and they need a lot of working capital to make that happen. Collateralized borrowing, so borrowing a crypto asset using another as collateral. So for example, borrowing USDC using Bitcoin as collateral. And then finally, the GBTC arbitrage. GBTC is a trust, a grantor trust, and what it allows is it allows people to get access to Bitcoin using their traditional brokerage account or retirement account. Normally, this is not possible. So the fund has blue, the underlying value of Bitcoin holdings per share. So it's raw value in Bitcoin, and it has the market price in Bitcoin. So that's what people are available. This is what people can buy it for on the open market. Now, what folks do is that they in order to get Bitcoin into the fund, it requires high net worth individuals or hedge funds to buy Bitcoin and then contribute it to the fund in kind. And they buy at the underlying Bitcoin holdings per share, the dark blue line. Now, normally the market price per share trades higher. As we can see here, there's typically quite a big delta, quite a big spread. And that's called the premium because it trades at a premium versus the underlying Bitcoin holdings per share. And so that's the fundamentals of the GBTC arbitrage trade is these hedge funds buy Bitcoin, contribute it in kind. They have to wait 6 months and then they capture that premium, the difference between that underlying price and the market price. Now what happened was, and I'll go back to this chart. So this is Grayscale's chart on their website. And this is a chart that distills the premium or discount. So the delta between these two lines. And as we see over the last couple of weeks, we've seen it dip down quite a bit where there's actually trading to it. The price is actually trading at a discount, which means the fund is actually trading less than the value of the Bitcoin that it holds, which is a really weird environment. And that occurs because there's more sellers than buyers. And Bitcoin also as well has sort of stayed flat and had a bit of a dip. So I would expect this discount to disappear as the bull run starts to increase. And as folks start to see this as a really big opportunity because it is trading at a discount relative to the value of Bitcoin that holds. Sorry about that. And so people worried that BlockFi was insolvent because they had such large exposure to the GBTC trade. BlockFi owns 5% of all GBTC, and the rumor started to circulate that there may be a large unrealized loss. Now, they don't realize a loss for some time. GBTC is trading at a discount, but that doesn't mean that they're at a loss. And that's where there were some unsubstantiated rumors linked to their insolvency circled around called like ditchblockfi.com, which is a piece of garbage website. Basically, a total slam piece that was actually, the website is owned. So here's the registrar information. The website's owned by CoinFlex, which is a competitor of theirs. So this website started to get circulated quite a bit. People started to get a little bit scared. BlockFi paused email signups due to a spam attack, and they had scheduled maintenance. This all fueled the flames of worry. And it's no wonder people have a heightened sense of worry when it comes to trusted third parties, as there's been numerous exchange hacks over the years, with people saying everything's okay. For example, with like Roger Ver with Mt. Gox, and don't trust, verify. After all, is a motto of Bitcoin. I think these concerns are overblown for many reasons. These rumors are completely unsubstantiated and propagated by their direct competitor and detractors who hate the idea of lending. We don't know what exact exposure or loss BlockFi may be incurring with the GBTC trade, and if there was a hole, there are many ways BlockFi could plug it. Borrow against their BTC shares, raise a round, which they actually did when I wrote this article. And BlockFi has survived much more intense moments like March 12th, 2020, where Bitcoin plunged over 40% in one day, and they didn't lose any of their clients' money. While these worries started to spiral, in the last 48 hours when I wrote this, or in the last 24 hours when I wrote this and the 24 hours after, the landscape changed dramatically. DCG, the company that runs GBTC, purchased $250 million of the Grayscale Trust to bolster confidence. And they've got tons more money where that came from. Also, they have the ability to roll this into an ETF or dissolve the fund and distribute all the money back in direct proportion, which again, it's holding just straight Bitcoin back to all the fund holders. There's also discovery that GCG was hiring roles required for an ETF application. So this is the news that came out on Business Insider. The world's biggest crypto fund manager is hiring 9 ETF-related specialists. So they're definitely looking to roll this into an ETF, which would make it directly redeemable and it would close that spread. And then also BlockFi announced their newly raised $350 million of funding. So this is on BlockFi's website. When I wrote the article, it's published on this exact date as well. So I was writing this while I didn't know about this information. BlockFi completed a $350 million round. Overall, we should be cautious with these lending services, but I don't see an issue with BlockFi. To me, the concerns were way overblown and hyped up, but I'm not an auditor, nor am I providing financial advice. I just think they were a bit exaggerated. A funny note on traditional banking, some balk at the insecurity of the lending and borrowing markets, but the mainstream markets have structural problems as well. For example, in the United States, there's something called FDIC insurance, which is a fund created to bail out banks if they fail. Currently, the FDIC insurance fund has $97 billion in it. Total U.S. bank deposits right now are $16 trillion. So only 0.6% of all U.S. bank deposits are covered. If one major U.S. bank failed, the fund wouldn't be enough and we'd have to require a bailout from the Fed. So the existing financial system isn't exactly this perfect, stable world that we all think it is. So overall, is lending Bitcoin worth it? Your keys, your coins. Not your keys, not your coins. So if it's your keys, you are free to do whatever you'd like with them. Is the return of BlockFi and these other services worth the risk? It's totally subjective and up to each person to decide. Is 6% enough? Is 3% enough? Maybe it's 10%. That's what's great about a market is everyone chooses what is an appropriate rate of risk for them and what return they would require. And ultimately, no risk, no return. But in taking risk, you can potentially lose your coins. There is no perfect answer for this question of should I lend my coins out? And we can remain discerning with risk, but BlockFi or any other service shouldn't be hated just because they're in the business of lending and borrowing. These services, I think, are a fundamental great demonstration of how Bitcoin is becoming an entirely new financial system, and we shouldn't be rooting for them to fail. I hope everyone enjoyed today. Hope this gets you excited about lending and borrowing. If you sign up for my newsletter, I will be covering the how to earn a yield on your Bitcoin next week. Thanks for watching. Cheers.